Greetings, market rebels. Excuse me, Wayne here. My partner Ryan's completing this week's market outlook. We're getting started with the sector situation. We just completed a macro measure. It is a little in front of 1:30 p.m. on September 4th, 2022. And I'm a little perturbed. I'll tell everyone, this regular viewer, it's been a really rough day so far due to technology. I'm not sure what's going on, but tech doesn't like me today and it's still not working right. Things are just not working for me. So let me see if I can, maybe I can fix this quickly. See if I can do that. And where are we now? Wow, yeah, it's just really big problems after what happened with super big problems with after what happened with Microsoft. Something happened with the Microsoft update is really affecting me. And I don't know why that's happening, but it really is. It's not, yeah, I can't even get the right recording to happen. Anyway, let's get to these the old fashioned way. Very frustrating, but everything was working really well when I tested it last week. And it's just always like that. I think Thinkorswim may be doing updates, 3.5 hours of fighting with these the software. It's been a nightmare. Anyway, we'll still get through sector situation. Hopefully it records. I had the problem with Zoom recording, several problems with it earlier as well. So this is our disclaimer. And then let's get into the intellectual property rights notice. So yeah, it's just been frustrating. It's not the end of the world, but just been frustrating because really wanted to get things rolling earlier today and just got stopped in my tracks by these different tech issues that keep one after another that kept popping up. I lost a lot of my charts. I lost notes I planned to share, but what I wanted to do is just quickly note that according to this tweet that my son sent to me, looks like I hadn't thought about this at the end of last week. It looks like Powell will be speaking 20 minutes before the market opens on this upcoming Thursday. So I would definitely keep that in mind as maybe a place where they try to do what they've done every time the Fed has spoken, right? Another thing is, remember, QT is theoretically starting to the tune of 95 billion per month, supposedly this month, September. So just remember that because the seasonality isn't very good to begin with. And if you've been listening to us, we think that the last 13 or 14 years of excess liquidity due to quantitative easing has been a big reason why stocks have done what they've done. And so we're not the only ones, of course, to share that view, but that's really the view I think Ryan and I both share. And we're also thinking, okay, well, this doesn't really bode well for those efforts, right? So we'll see what happens. The other thing is, good to note, maybe insiders have really stepped up selling their stock. So their timing may not be impeccable or perfect, but they usually have a good handle on things. And they've been dumping things at an increasing rate. And here's some of that seasonality of, here's your mid-aug, which didn't play out exactly as expected, I would say, right? But here's your early SEP, mid-SEP, and then late SEP. So September's considered maybe the worst month of the year, I think, for good reason, right? This is typically what happens. So never a guarantee, of course, but and here's just another look at your insider transactions ratio spiking to the into bearish territory. Finally, remember that we could be on the verge of another leg down, and so if that's the case, just remember that bear markets tend to be back end loaded. Okay, which is the point they're making here. So that's when you could see what happens in terms of the rally, what happens after significant rallies and the stages that you get to and how much gets lost. And you could see that the first third of a bear market, 9%, I'm sorry, mean, we'll just look at the mean, 11%, 12%, and then 24%. So pretty rough stuff in terms of if this is second, we'll have another rough go of it, maybe even rougher go of it. And if there's the third or start of the second and third, you've got a lot more to go potentially. So just keep that in mind as we take our look at the different sectors. So we'll cover these 12 quickly. And again, I don't plan on always being quick with these, but again, we've talked about this so many times this year where when we go to more of a risk off scenario, then you get that behavior in virtually all the sectors. So we know that energy is maybe a little bit of its own thing, and that acted a little differently, and it has been. But if you look at, for example, technology, this is the Friday's candle right here. If we look at communications, Friday's candle, and so on. I'll enlarge all these as we go, but there you go. Big reversal candle in transportations, in financials up here. I omitted that. In healthcare, XLV, also staples, consumer staples, that got reversed hard. XLY still reversed fairly hard. That's consumer discretionary. Real estate reversed hard. XLB, building, basic materials, that reversed hard. Industrials, XLI reversed hard. Utilities also reversed. So there's those. There's this too. Let's get to a good chart. Let's take a look at semiconductors, SMH. This was a great week for TNT UOA Pro folks that were trading in. Thinkorswim's getting me again. This is minor though, at least it's not catastrophic. But this was a great week for folks in a lot of the semi names and puts. Obviously, we were fortunate enough to select NVIDIA for the idea of the week in our TNT service, and that just was outperformed our greatest expectations. AMD, ON, there were just a couple other names we had in that semis as well for bear sides, and it was just a really good week. They reversed hard though, right? They probably got down towards, not at, but towards oversold here, but then they end up trying to bounce, and then after closing this little gap here, they get sold into hard. So that was, excuse me, that was very interesting, and that did not close well. XHB, the housing ETF, that also had a candle where it reversed hard below. It's worth noting that happened below the 100 there in the white dash line, it just a little bit below the 10 SMA that's downsloping in that white solid line, and then the gold line's my 50 SMA. So right below keys resistance in the forms of SMAs, it struggled and reversed. And that was what we were thinking. If they did put a little bounce together, we'll have to see how it would act there, after thinking that we'd more or less be coming into a bearish week last week, and we did. They did find support, and then they did go ahead and try to reverse things. But as everyone knows at this point, that Gazprom news wasn't received well, and understandably so. And then metals, which have just been an absolute dog, the dog of dogs this year, just from the start, just continues. I kind of thought we might be onto something about a month ago there, but nope, they weren't able to push, excuse me, up and through that downsloping 50 SMA there in gold. That kept everything hemmed in here. And you could see all the lesser SMAs, the 10 in white, the red 15, the 20, light blue is the 20, and then 50 in gold, 50 SMA in gold, all downsloping along with all the other long-term moving averages. So this isn't over. I'm happy to be getting beat on my physical silver purchases so far. That was my hope, that I would start buying, and hope that I was buying too high. And I'm going to continue to add at larger quantities, the cheaper they make silver, gold, and platinum. That's my plan. It's just for hedging. Talked about it here and there, Market Rebellion, over the last several months, more and more. But just want to let people know I did buy a little bit. I think was the start of last week or the end of the week prior. So I bought a little bit more, and I'm hoping to get it even cheaper. And if we look at a little bit bigger picture here, let's do that. I know a lot of people are thinking about that. One little overzealous mouse over, and I have to deal with that. There we go. So let's get this to them there. So you can see where this is breaking down at right here. And I think there's probably going to be another level down. Let's call it another, I would say another 5% or so. I think it would be about 5%, roughly 5 to 6. From the low, only, let's see, the low would only be another 2%. But from where it closed, I think it's about another 5% that it comes down into here. And I think that's where there'll be some good support from the 90 to 92 band. If that doesn't hold, my gosh, but we can look at super big picture and see. And I would again, frankly, I'd be thrilled. But if I were able to see the silver and gold and platinum get even cheaper, excuse me. But I'm thinking 92-ish, 90 to 92 to me is in the midst of a lot of action. It's just in the midst of a lot of action there. There's that range. So I'm thinking we come into there. The way things look, this doesn't look good, right? It's hard to say, well, hey, this thing's looking good. It could start to turn around, of course, at any time, but even on the monthly chart we're looking at, this is only at about 39 on the RSI. So there's definitely more room for this to continue to sell off on that simple oscillator look right there, or simple indicator look right there. So keep that in mind, because that would probably be a good thing for hedgers. If you're trading this as a vehicle, you have my sympathies, because the metals markets are notoriously difficult to trade. They're tough energy. I feel like if you're in the very short term, energy and the metals can really play games with you, a lot like the IBM specialist. But that's the thing. They're tough, but you can still see that over the course of time, things do play out more or less the way they do in other things that trend, right? But it just sometimes from day to day, it can be hard to keep those things managed well. There are definitely some head scratching moves that happen in energy and metals. I think more so than a lot of other spaces. I mean, I think commodities probably are like that. So those are some of the big things I wanted to cover in terms of the sectors. They're going to risk off. You can see that. And we may as well just kind of talk a big macro, because with everything being risk off, that means that a lot of it's behaving a lot like the market, since the market's becoming more risk off over the last several weeks. So we're thinking, right, we had a big level at 390, it held, but the way that everything's shaping up, if I had to force a trade without knowing how we open on Tuesday morning, I would still have to lean short. I'd still have to, I even noted this in Rebel Pit at the close of trade, I would have overrolled all my puts to slightly out of the money, collected what I could off of having maybe been slightly in, that became further in the money due to the movement we saw last week. But I would have definitely overrolled and stayed short, though, because this close was ugly. This big reversal candle, call it a bearish engulfing, call it whatever you want, but that's an ugly finish. And it did so with volume picking up. Now, I noted this in Macro Measure, that video shortly made a few moments ago, that this was a little caveat there, because it is effectively the unofficial last trading day of the unofficial end of summer and all that kind of stuff. So that's true. And so it's hard to read into things as you normally would. But if you just take it at face value, this doesn't look good. And especially, right, with a lot of these shorter term SMAs rolling over, downsloping, all the longer terms, except for the 50 there in gold, are downsloping at this point. That's the way my eye catches them. So not a good view. I mean, it's very hard to make a bull case at this point. Could there be a little weakness and then you bottom out here and you hold, and that goes on for a couple of days, and then you start moving up, and then yes, of course that could. And you would then be able to then flip to this. I think frustrates people that are new to this stuff. But if I'm a big believer in being nimble and open-minded in the markets, and a lot of you've heard that way too many times, but I'd like to be incrementally charting and reacting to the latest developments, right? That's just my approach, that as a market maker of many years on the floor, and then of course desk trading for a while, but as well. But excuse me. The reason I'm saying that, though, is my outlook would change if we held up in here and then we started seeing a lot of breadth improvements, and we started moving back up, and they were really buying stocks. And the reason for that would be that you would have this noticeable higher low put in versus all these lows, right? So that if that were to develop, it would be, let's go with it. Just like we embraced this, even though we thought it was mostly just simply due to have a rally, and that short covering would likely help deliver that rally, and it did. But what's happened here is there were a lot of shorts that got chased out, and once it kept going, they repositioned themselves as longs. And I do believe, from what I've read, there's a lot of longs that are relatively fresh, strong longs in terms of how much they put in that are now trapped on the long side. So this people that are just getting churned up by this action because they're too late to react to it, and then they refuse to see the turn again and hold, they're getting themselves in deep trouble repeatedly this year. I've seen the CTA data get flipped and other measures like that. So I've seen a lot of things that have said there's a lot more people long this market. There's not enough people as bearish, despite the claims that everyone's bearish and everyone's short. It's just not bearing out when you see some of the interesting posts and data that are out there in certain reports. And I don't have time, unfortunately, to flash those, but I'm looking at this and saying, look, almost everything went to risk off in the sectors last week. This is looking challenged, to say the least, right now. You just can't rule out coming down to lower support levels, like 385-ish here in the SPY. Then maybe it looks like somewhere around 380. There's another one. Kind of unsurprisingly, sort of, because this happens way more than you think it should, somewhere near 375-ish. Like, it just starts to happen every $5 the way that this price action is traced out. But it is what it is. There are gaps here. I think there still is a gap here. Let me just make sure that's the case. Okay. Yeah, there's a mini gap or slight gap there. So that could matter if there's a retest in the cards, just to help and gravitationally just pull things towards the gap if they get close enough. That's pretty common, I think. But this is really not a good finish to the week. And with the seasonality overall for September is just not very good. Usually you start a little ugly, then you kind of tread water for the mid part, and then the sell-off resumes. So maybe we'll get a little bit more downside, tread water, try to rally a little bit, fail, and then you get a resumption to finish out the month if the seasonality holds. And I believe the seasonality is that way for the second year of a Democrat president as well. That's the data that I've seen. So just not good. I mean, seasonality just doesn't favor good things happening in a big way, at least in the very near term. And with insiders stepping up. And then my final comments are this, that with people flipping long the way they did, and the excess liquidity theoretically starting to be taken out month by month by the Fed, right, with the quantitative tightening as opposed to quantitative easing, excuse me. And the fact that energy has gone absolutely mad across Europe. And that is, I don't think even, you could talk mom and pop, but I would say even intermediate or medium-sized companies are probably going to struggle with some of their power bills, given how insane it's become over there. And that could produce at least temporary layoffs. And if that does, and you of course will get a ripple effect, because it's the European Union is such a large part of the global economy. So that can't be good for exporters to Europe either, let alone exporters from Europe to other places. It's just not good. And the developments continued not to be good. And I think the productivity is already cratering in the United States. There's really the recipe for further deterioration. It hasn't shown up in jobs, but I did see a lot of data this weekend thus far that really demonstrates that jobs tend to lag, which makes complete sense to me, but that's what the data also shows. And we may be looking good the way the government calculates jobs, but productivity is horrendous. And I think job losses are coming. I also think that with inflation raging here still, and mortgage rates so high, and home prices so high, and inflation putting such a squeeze on American consumers already, who are really over indebted again, ratcheted it up again, their debt holdings. It's really not a good recipe for good things. So I think you have to really be thinking that way. The trend is down. There was corrective activity. I think in the long run, I would say odds favor this phase right here to go down in the books as of right now, as to more of this corrective phase here. We'll try to draw it like that maybe, but that whole phase there in that range, that is going to, I think, look more like a corrective wave. But we'll see, right? That's what we have to do. We have to always adjust and stay nimble. But as of now, if we look a little bit bigger picture, I think you'll see, well, maybe if I have the right chart up, you'll be able to see it. Let me get the 1 year. Here's your 1 year. And I think you'll see this is your several, right? But you're really, this is your major impulse lower. Here's your correction to that. And I think this is the start, maybe, of course, of a second leg like this one. We're similar to it. It could be, of course, even stronger. And if it is, that's really, really rough stuff. I lost a lot of my data, unfortunately, and drawings on Thinkorswim. I cannot get them back. So I apologize for that. But I did have some other good lines out. We just don't want to hold off on these videos even more. But I was talking about this on Cocktail Hour, and things definitely project lower if we do have another leg here and you can't hold these lows. It could be really, really problematic. But remember, the rough stuff usually does happen in September and into October. But then if things start recovering, typically in October, and then for the next 2 months, generally speaking, things are pretty good. And even January's overall usually a good month in my recollection. February tends to be the corrective month to the celebratory action that happens between late Oct through January. So that's usually how the seasonality plays out in my memory. I think I'm accurate there. Excuse me. So maybe, right, we do get that. Maybe once the midterm elections are settled, they start feeling as though they've got a good beat on what the next couple of years are likely to look like politically. And maybe that matters, right? And the market starts getting more squared away. And maybe we see such poor developments economically that you're getting close to where the Fed finally decides to halt. That would be my sort of long-term basic thinking on the whole thing. But that's what I would share with everyone, even though this is sector situation. Again, basically, we went back to risk off overall last week. We certainly went back to risk off on Friday. And with everything trading like the market, until it starts to stop doing that, just expect most of these sectors to behave that way, except for the ones that have the capability to act independently, which due to their own specific news. And that does tend to be metals. They're kind of their own thing. Utilities can be their own thing. Energy certainly can be its own thing. But a lot of these other things are looking pretty rough. And I noted this in the macro measure video that if you look at copper, if you look at lumber, if you look at oil, they're not looking healthy in terms of really strong economic demand. So this is all looking kind of rough. And so I would just take it at face value and adjust accordingly. And so I hope something I was able to put together in this video is of some value to you this week. You get maybe one little nugget out of it that'll help you out this week. And we'll be back in touch, of course, through our webinars and through the newsletters and through updates, through Cocktail Hour, through the roundtable if we have one, all that stuff that we do during the week. And I want to wish everyone a great and safe conclusion to their Labor Day holiday weekend in 2022. Thanks for tuning in.